This video was made possible by Hover. For the last 6 months, you have been thinking to start a business. The only problem you have is you don't know what business to start. One day on your way to college, an idea strikes your mind. You pull out your phone and write it down. You rush to your home and start planning. Everything looks perfect. You know how to turn your business idea into a multi-billion-dollar company. Congrats! But it's too early to celebrate because you don't have the capital to start. You gather your family members and you explain to them the idea, hoping that they will invest in the company. Everyone thinks you're crazy, except your uncle. He decides to bet on you. $10,000 in exchange of 20% of the company. It might not seem much, but it's actually a lot, because your uncle just valued your idea that's not proven yet at $50,000. So you register your company and issue 100,000 shares, and your uncle gets 20,000 of them. You start building your website and designing your product. In few months, you run out of cash and you need to raise more money. Unlike the first time where you simply had an idea, now you have a concept to show. So instead of going to your uncle again, now you can do something different, like talking to some of the big guys, such as angel investors. Angel investors are usually the rich dudes who are looking for innovative ideas or young entrepreneurs to invest in, something like sharks in the Shark Tank. It's not easy to convince these guys to throw money into your business, because statistically 9 out of 10 businesses fail, and you have to prove to them why you are an exception. After talking to multiple angel investors, luckily you could get one of them on board. But first, you have to agree on the valuation. There is pre-money valuation and post-money valuation. It's not as difficult as it sounds. Pre-money valuation is how you value the company before receiving the investment, and post-money valuation is pre-money valuation plus the investment. The higher the pre-money valuation, the less portion of the company the investor is going to take. You enter into a negotiation and you convince the investor to throw $1 million into your business with $2 million post-money valuation. So the investor is going to take 50% of the company, and your shares will get diluted together with your uncle's one. That doesn't mean you're going to have fewer shares. The company will simply issue another 100,000 shares for the investor. So now there are a total of 200,000 shares and your stake is 40%. With $1 million, you rent an office, hire some graphic designers, engineers, and specialists to complete your product. Finally, everything is ready. You're about to launch your product, app or service, whatever. But guess what? You're out of cash again, and you still need a marketing budget and salespeople. So you decide to raise some more money. You go for a Series B. This time, you meet some VCs or venture capitalists. They're not your typical angel investors. These are the guys with MBAs and work in venture capitalist firms who take other people's money and invest in companies such as yours. Anyways, after multiple negotiations, they decide to bet on you. Since you already have a team and a product to launch, your company hopefully now worth more. Let's say VC offers you a $10 million investment with $20 million post-money valuation. You find that offer fair and you accept it. The company issues another 200,000 shares and everyone's stake gets diluted again, since the VC just purchased 50% of the company. In case you're wondering, no one has lost money so far. In fact, everyone just got richer. The angel investor, for example, had 50% of $2 million when he invested in the company. Now he has 25% of a company that's worth $20 million, which is $5 million. In fact, your stake now worth $4 million. Anyways, you can go for Series C, D, and so on. Few years has passed. Congrats, you have made it. Your idea turns out to be a success. Your business is finally making money. Remember, everyone who has invested in your company has been waiting for you to grow big enough so that they can cash out, especially your uncle, whose $10,000 now worth millions. You have two options. You either get sold to one of the giants of the industry like Instagram did, or you go public like Tesla, and that's known as IPO, Initial Public Offering. It's just another way to raise funds and issue shares, but this time anyone can buy them. They're open to the public. In fact, people can buy and sell your shares among themselves in the stock market. Of course, we have missed many things in this video, but it's the short, oversimplified version of how you raise money for your business. If you are an entrepreneur and you are looking to start your business, now you know where to get the money from. But what's also important is that you need to have an online presence, and that's why you should use Hover, because Hover makes purchasing a domain easy and simple. That's exactly why I use Hover. In fact, you don't have to waste your time figuring out everything on your own, because they have the best-in-class customer support team who will help you with everything you need. Whatever domain extension you're looking for, you can find it with Hover, because they have over 400 domain extensions, so you will definitely find what will fit your business. On the top of that, you can create customized email addresses using your domain to make your business more professional, and you will get all that for 10% off using the link hover/proactivethinker. Make sure you give them a try. For now, thanks for watching, and I will catch you in the next one.